Hello guys, my name is Gavin. Welcome to M Trading's webinar. So to start off, let's do a wrap up of what's taken place in the markets from this weekend. And in the UK there is a bank holiday yesterday. So there was a bank holiday yesterday which decreased volume in the market. So we had Jackson Hole over the weekend, which allowed for central banks to meet up together and describe and talk about their monetary policies. From there, we had bank holiday in the UK, which remember that 40% of the volume is from London hours. 40% of the FX market volume is during London hours. Yep. So that took away a lot of volume, and we could potentially see some exaggerated moves based on macros and any surprise factor. And the surprise factor being, well, two things. One, we had over the weekend and towards the bank holiday Monday, we had a hurricane over Texas. Yep, so Hurricane Harvey, as it's called, which is projected to at least, we're looking at 50 inches of water. Yep, 50 inches of water is forecast currently. Yep. So that has had a huge impact with the US markets. But it was anticipated, so it wasn't anything new, it wasn't a surprise, it was anticipated. So we did see a small sell-off take place. The next point being is North Korea. So North Korea shot a missile over Japan. So they literally shot it into the sea over Japan, which straight away caused market turmoil. Yep. So risk. So there's two factors that take place in the markets. One is risk on, the other is risk off. So what do I mean by risk on and risk off? Okay, a lot of people will be talking about in the markets, especially if you're watching Bloomberg or CNBC, any of these shows, they will say we're in a risk off scenario today. So risk off generally means that investors and traders are moving their money from riskier products into less riskier assets. More likely safe haven assets. So what is seen as safe haven? Precious metals such as gold, silver, major currencies such as the dollar, which is the greenback, along with the yen, the euro and sterling, and also the Swiss franc. Yep. At the same time, money will move from stock market into bonds. They are less risky. They are backed by the government, especially not emerging market bonds, but bonds of major governments. Yep. And what is risk on? So risk on is when there is a time of market economy growth, positivity in the market, sentiment is also very positive. We will see investors and traders move their money from risk off assets, which is safe havens, less risky products, into more riskier products. So you'll be looking for high interest savings accounts, emerging market currencies, emerging market saving accounts. Stock market will be another. So moving money from bonds into the stock market, into other precious metals. Other precious metals could be seen as diamonds, platinum, to other metals. Yep. So more commercially used metals such as copper, iron, ore. Yep. So watch how these markets are being affected by these risk on and risk off scenarios. This market's been fundamentally driven, especially in the last 2 days. Yep. Okay, guys. So our class today, our webinar session today is going to be based on secondary indicators, guys. I know some of you have been looking forward to this, so we're going to go into secondary indicators. Okay, some key points I would mention. So one thing I want you guys to remember is whatever indicators I'm going to bring up today, it is based on price action. So it is all a filter of price action. All we're viewing is if we're seeing from this high down to this low, how much momentum has there been to this low? And we will see a secondary indicator reflect that to us. So a secondary indicator is only a reflection of price action. It does not, it is not a extra confirmation to take a trade. Yep. It should not be used as your only confirmation to take a trade. Yes, use it in confluence with your primary indicators, which is price action itself, using support, resistance, trend lines. But when we're looking at secondary indicators, it is just a filter of price action. So today I'm going to cover secondary indicators which are on the chart itself. So these will be represented on this chart itself. Yep. So on this chart itself, it will be present, and we'll have a better understanding on how to use these indicators. We're going to go through 3 indicators. So we're going to go through a long term, a medium term, and short term. So that will benefit most of you guys. Yep. So if you're looking at a long term time frame, yep. So that is, we'll start off with, say, let's go with the daily. Let's just remove this. Yep. Let's just go to normal. Okay. So we're going to go through. Let's just zoom out slightly to give us a bit more price action. Let's go to a daily time frame. There we go. Now this is the S&P 500 on a daily time frame. We're going to incorporate some indicators which give us that longer term projection and longer term view. Yep. A key indicator that's used in the market is known as moving averages. So let's just bring that up on the chart itself. It is a trend trading, it is a trending indicator. So it is based on trending markets only. It doesn't work too well in sideways markets. So that's the first point there, guys. Only use the moving average to filter out whether the market is trending, and then it should be used in that market condition. But if it's in a sideways, in a consolidation, the moving averages will not work well. You'll be whipsawed in and out of positions, quite volatile positions. So moving averages. So you click on moving averages. There are 4 main types, but we use mainly 3. A lot of traders will only use 3, which is a simple, exponential, and linear weighted moving average. Yep. So we're going to go with a simple. I'm going to go through a simple moving average. Let's go with a simple moving average of 50. Let's just increase the thickness of this so we'll be able to see this clearly, and we'll change this also. There we go. That is a simple moving average of 50. So what is a simple moving average of 50? Okay. So remember that the moving average is just giving us the median in price action. So we define the amount of periods. So it's giving me the median price currently of the last 50 periods, which is the last 50 candles. So because I'm able to see the last 50 candles being up to, say, around this point over here, yep, it's giving me the median price currently. Yep. So the way to use it is, there's a number of ways. Yep. The first being as a support or resistance. So as a support or resistance, we're able to better understand how price action is flowing. Yep. So we can see how it's been tested in this area here. We had a breakthrough, but again, a test here, a test here, a test here. So every time price action comes back to the moving average, it is a retracement. It is a retracement. It is testing this as a support level. Yep, that's one key point. The second point is in an uptrend, you would expect the moving average, if I just go to my drawing tool, you would expect the moving average to be above, you would expect price action to be above the moving average. When price action is above the moving average, it is a positive indication. It has shown you that the most recent prices compared to over those 50 periods, those 50 candles, has gained significantly more than the average, than the median price. Yep. So that is a bullish confirmation. Whereas if we now switch this up and let's go to trying to look for an asset which is gonna, okay, let's remove that and let's scroll back. So we're going to scroll back to this. Here's another point. So we can see at this point here how moving average at this point here is above price action. So in a downtrend, you will see price action being below. The crossover takes place. Yep. So this is showing us that the momentum is weaker than the average. Okay, so that's the key point there. So remember that it is used for support and resistance. So in this case, we're seeing this as tested as a resistance level, and again there as resistance. Yeah, so each time it's been tested as resistance. At the same time, it can be tested as support level. And the other point is, when it crosses above or below the moving average, it gives us an indication of weakness or strength. Yeah. Next point will be is, how do I trade this? Well, a lot of traders, let me start off with this. The number one key point is that moving averages are the only indicator that allow you to be in the market all the time. So for an example, let's go with an example. If I just go to normal. So if I take this trade here, so as soon as price action crosses above the moving average, and also wait for the indication that it's starting to point upwards. When I have the indication that the moving average is pointing upwards, that is where I'll look to enter. So I can enter at this point and stay in the market all the way through, stay in the market all the way through, until we have a significant breakout. When we have the breakouts, remember we could have taken the breakout here, but we didn't take it because moving average is still pointing upwards or going sideways. When we have the break below the moving average and the moving average starts to point and face downwards, that is where we could sell. So we could sell in this region here, take it down to this low. Again, you have the cross above. It's going sideways, so I wouldn't enter there. You'd probably enter when we start to face upwards around here. Yep, so you face here, and that is when you switch your position. So it allows you to stay in the market at all times, or you can filter the trades by the amount of confirmation you require. Yep. So moving averages is one of the key indicators used in the market. It is the most popular indicator, guys. Just to let you know that it is the most popular indicator. But there is an issue. The issue being is when you're using a single moving average, it does allow a lot of whipsaw in the market. As you can see over here, for example, if I just take this drawing tool, so you have the crossover in this point here. You sell, and then again it crosses back above. Then you buy, and again it crosses below. You sell, and then it crosses back above. You buy. So you would have either been break even or made a loss in this stage here. In this price action here, you would have either broke even or potentially made a loss. That is the key point there. Yep. So to reduce false breakouts and add extra confirmation to your trades, what do we require? So what we can do is, instead of looking at a single moving average, we may look at a double moving average. So it's two moving averages together, which will give us a better indication. Okay, so let's add our second moving average. Let's just go to this. Right, so let's go to our indicator list. Let's go to trend and moving averages. We'll add another simple moving average, but this time we'll look at 200 periods. So that's the last 200 candles. And let's change this color to, let's go with that color there. There we go. So this is an example, guys. You would want to break out when price action crosses above your 200 and your 50 moving average, along with both lines, both moving average lines are facing in the same direction. Yep. Those are your key points there. So, for example, if I zoom out of this is a perfect example how this would have worked very well. So assuming, let's go back right down to this point here. And let me just get my drawing tool. So we have the 50 period moving average crossing above our 200. That is our first indication. Yep. Price action is also above this point. At this stage, they both are facing in the same direction. When they're both facing in that same direction, we could take an entry at this point. Assuming that we take an entry at this point, say we put a stop loss below both moving averages and say below the previous swing low in this range here. Yep. So let's just do that now. I'll do that with actual horizontal lines. So let's put in a horizontal line at this point here. on my next horizontal line at this point here. As price continues, we have a retracement. We have a retracement of the 50 moving average to the 200 moving average, but does it break through? No, it doesn't. So your indication of to close this position would be when the faster moving average crosses through the slower moving average, yep, which doesn't take place over here. So that's the key point there. So it doesn't take place at this point here. So you'd assume, okay, a little bit of a false breakout, a bit of market volatility, therefore I'll stay in. Yep, my signal is still intact. You wait for price action. Ooh, let's just remove, let's go to normal. So again, it tests this level, tests, but nothing, no crossover between the two moving averages, and you're still in this market. And then and it continues. And you can see how it's respected. Yep, so each time it is respected these lows, this low, see this low, breakthrough here, so a false breakout through there, but again, what is your moving average doing? A slight dip and a continuation. Yep. And then we'll continue. Your actual sell signal is at this point here. Your sell signal is here. So you'll probably close the position somewhere around here. Your position will have closed at that point. I'll take a horizontal line there. There we go. That is your sell position there. How much would you have captured of this one, of this market? As you can see, this is where you've entered. This is where your stop loss was. You would have captured up to this point here. Ideally, we're not looking to grab and attain the top. Yep, we're not looking to achieve that top. We want it to fail. You want it to fail so that you know that's the end of that uptrend. The last one to do is take a profit here, and then it goes on to continue for another 20, 30, 40, 50% higher. Yep. So that's the benefit of using moving averages, guys. Okay, so that is used for more longer term analysis. You'd hear a lot on Bloomberg, CNBC, Reuters, and all these websites. They do talk a lot about the moving average, and especially the daily moving average. So they use this on the daily time frame. Some good parameters to look into are the 200, the 50, which we've gone through, along with the 20 and the 10 period moving average. When you're looking at the difference between the simple, the exponential, and the linear weighted moving average, that comes down to how quickly do you want your confirmation. Because a simple moving average is given equal weight to all 50 of these candles, whereas a 50 exponential moving average will give more weight to the most recent ones, and a linear weighted moving average will give more weight to the most current candle than the last 50. So therefore, those are more faster reacting with price action. But the most confirmation you can receive for a crossover between the moving averages is from the simple moving average. And remember, guys, it is a lagging indicator. A trend line will give you an earlier signal. So just to give you an example of that, so let me just go through. If I just now shift this to the right, assuming you have a trend line, let's assume that our trend line is at this point here. So we take a trend line, something similar to this. So assuming this is my trend line over here. So I've got high highs, high lows all the way through. Once we break through this trend line, I'll take an entry at that point. I have a tight stop loss, a higher reward potentially to achieve back to these previous lows. Yep. My moving average wouldn't cross over till they both are facing down. Yep. So to give you an example, so when this starts to cross through, this one goes through, and price action is somewhere there. So you would be entering at this point here. So that is the difference between a trendline breakout and a moving average confirmation. So it is a lagging indicator, guys. Okay, so let's move on to our next indicator. So let's bring up another chart. Let's go with gold. So let's put on the chart window. Let's change the template. The next indicator is used for medium term. So this is the medium term analysis. Yep. So this can be used as, say, the 4 hour, the 1 hour time frame, anything from the 1 hour up to the 8 hour time frame. So indicator, it is a Bollinger Band. Let me just choose the correct tiers. Okay. This is a Bollinger Band, guys. So what does this do? Okay, to be specific, this is only a 20-period moving average, guys. So the line in the middle is a 20-period exponential moving average. So it's an EMA, as what we discussed from the previous indicator. So this is an exponential moving average of 20 periods. It's taking the last 20 candles and considering where is that median price. Yep. And the two lines that you see, the one above and the one below, those are your standard deviation. Yep. So it calculates what is the volatility in the market currently, guys. This is what the benefit is of this indicator, and that's why it should be used mostly. It could be used in the short term, could be used in the long term, but I use it best in the medium term, and it works really well in the medium term. So it shows us what has the volatility been. Yep. So looking at gold. Yep. So we're looking at gold, guys, and I spoke to you about at the beginning of this webinar how assets and, well, how traders and investors are moving their money from riskier products into less riskier products, and there is a momentum to safer havens. Yep. And a safe haven is gold. So we can see what's taken place, guys. Yep. So you can see this drive up. So we can see this drive up. You can even see a gap taking place. So there is a gap that closes. So the gap is quite a large gap. So we break above that 1300 barrier. So we not only cross over 1300, but we gap higher, almost reaching up to 1323 level, 1323, 1324 level, in that range there. Yeah. And then from there we had a small sort of indecision. You can see amount of volatility. When you see a candle such as this, so let's just zoom in. And I've covered in my previous webinar candlesticks. When you see a small bodied candle, very large wicks, it shows that there's a lot of volatility in the markets, but no actual direction. And this is extremely important because this volatility is greater than all other candles within. So that itself, this could be seen as support, that could be seen as resistance. And you can see how market did not go on to realistically break through significantly above that high. But we're now going on to test this low. So this is seen as your support and resistance. Yeah. But just to go into it, guys, what I want to cover is that the Bollinger Band shows you the volatility in the market. So from the 20-period moving average and how it starts to incline, there's a strong upward drive. And we're on the other side of that Bollinger Band where it's two standard deviations. Yeah, so you can see there's a strong drive up. So how do you use this? A couple of ways. You look for two types of trades. One is when it's extremely overbought or oversold. Yep, so when it's extremely overbought or oversold, it will go on to hit either the upper Bollinger Band or the lower Bollinger Band and reject that level and bounce back up to that moving average. So naturally this has been due to a risk-off scenario, so more fundamentally driven. But if you look at the candles within, so if I just zoom out slightly, so looking at something like this, so you see how market moves straight up, hits the Bollinger Band, a lot of rejection there, and sells off. Gets down to this lower Bollinger Band. So let's just describe this clearly. So you can see how there's rejection in this level here. Rejection at this level breaks down to the lower side. Let me just see. Why is my... Okay, cool. Yep. Get down to this low over here, and we break up to the top side. Yep. So that is the key point there, guys. You can see how market is respecting the Bollinger Band. Each time it's at the lower point, it is oversold. We can then take a trade back up to the mean, back to this mean price there as a minimum target. Maximum target back to the other side of that Bollinger Band. Yep, that's one way of trading it. The other is looking for a pinch. So pinch is known in the market when both Bollinger Bands start to squeeze, when you have the upper and the lower band start to squeeze as is weakness between the two moving, between price action between the buyers and sellers. Something similar to this price action here in the middle. So if I just highlight that. So something similar to this price action in the middle over here. Yep. You can see how this Bollinger Band is squeezing into this, and so is this. Yep. And what you're waiting for is initial breakout. When you have that initial breakout as such, breakout above these highs, that is your trade entry. But this did go on to break first lower, reject the lower price, and then move higher. Yep. So you do need to look at your major time frame, guys. I've covered this in my previous webinar. Look at your major time frame to see where is the trend. Is the trend still bullish or is the trend still bearish? Yep. But the Bollinger Band tool is great for medium-term forecasting, and it allows you to view the volatility in the market. Yep. Okay, so let's move on to our short-term trading indicator. Our short-term trading indicator, let's add another asset. So let's go for the euro dollar. Let's change the template. It's a lot more clearer. Okay, so the indicator I'm going to use, it is a custom indicator. It's a custom M trading indicator, and it's pivot points. Here we go. Yep. So this allows us to view what is the current support and resistance levels in the market. There we go. So PP is your pivot point. The way the pivot point is calculated, remember it's a secondary tool. All the indicators I'm covering are all secondary. Ideally focus on primaries before you move on to your secondaries. But this pivot point here is used in the market. It's been used for 30 plus years. It's been used since the pits. Yep, in the pits. I was speaking to one of my friends recently, and he used to trade in the pits, and he used to calculate every morning pivot points in his head straight away. You could do it in a couple of minutes. Yep. To give you an understanding of what the formula is, I'll give you just the PP. The PP is your median price, so it is the previous day's high, the highest high, the lowest low, and where price action closed. You add those three numbers up and you divide it by 3, and that is how you work your pivot points. Yep. And then there are additional calculations, formulas for your R1, R2, R3. The R's meaning resistance, your S's meaning support, S1, S2, and S3. So they calculate automatically onto the screen support and resistance levels. Yep. So one key point I want to mention is that 45 to 48% of the volume in the market is not electronic yet. Yep. So, okay, there is electronic majority, so people trading through their computer system, through their broker terminal, but there are still 40-45% traders and investors that trade by just calling up the broker, finding out what the price is, and placing their trade that way. And most of them tend to be larger traders, more institutional type of traders, more professional type of traders. So you need to know your pivot points. Yep, they are highly respected in the market. Okay, so one key point. Well, just have a look over here, guys. Straight away, there's an example. That's totally random. I didn't know there was an example here. But look at this. How price action has driven all day higher and higher and higher. It gets up to the R3 level, and you see rejection at that point. We're now moving through the R2, and we're potentially going to test the R1 for this retracement move. Yep. So pivot points are great to add, especially if you have, assuming that this level here, if I see this level here was also my resistance level of previous price action. If I have a resistance level and a pivot point matching up at the same price level, it gives it additional confirmation. So that's the key point there. Yep. The way to trade the pivot points is two ways. You're looking at the bounce and you're looking at the breakthrough. Ideally, remember this is short-term based, so you should be on a smaller time frame. I'd view a time frame of, say, maximum up to 1 hour, but most commonly it's used on the 30-minute, 50-minute, 5-minute, 1-minute time frames. Yep. So what we're seeing is the bounce is very specific. So when price action goes up to a pivot point, being this pivot point over here, you see some rejection at this level. When you start to see some rejection, when you see an impulsive candle, so an impulsive bearish candle that breaks below those rejection candles, that is your confirmation of a trade. The idea is you take your trade at that point, you have your stop loss above the high. So you take your trade on this candle here when it breaks this low, that previous candle low in this range here. Your stop loss above the high, your target is 2, you can have it to the next pivot point. But if you're looking for higher risk reward, you can go to the pivot point after that. So you can continuously extend your target levels with your pivot points. Yep. So that is one way, which is the bounce. A breakthrough is when you're looking for price action specifically. Yep. So when price action goes up, so it goes up to test this level, test this pivot level, it rejects this level, bounces off, and then moves higher, breaks above that level, you enter at that point. Enter at that point, you place your stop loss below the pivot point, and your target is to the next pivot or the pivot after. You can extend your target to multiple pivot levels. And guys, these are used on pit floors. Electronic traders who have originally been pit traders and now electronic traders, they still use them, and they are also as popular as the moving averages. So guys, I've covered three types of secondary indicators. All of them have been on the charts themselves. So next week I will be going into oscillators. So that is a secondary chart that's below your primary chart that give you additional information. But what I wanted to cover today was specifically on the charts, giving you an idea of what can be used as a secondary confirmation to your primary analysis. So we've covered the 3 most popular ones, which are moving averages, Bollinger Bands, and pivot points. Please do go through them, test them out. Back testing and testing your strategy with them is crucial. It is crucial. Trial and error will get you to where you want to get to. So you need to really thoroughly test these indicators. Let me know. Send me some feedback in regards to which indicators you prefer, and how you use them. Also, if there are any other indicators you've read about or you heard about, please do mention them to me. I can cover that also in another webinar. But for now, guys, we're going to call it a day. Hope you enjoyed this webinar by M Trading. And yes, we'll go into our secondary off the charts indicators next week. Take care, guys. Have a good evening. Bye-bye.